Welcome to the PlanStrongerTV market update for Wednesday, August 26th. So let's take a look there. Your 2025 numbers, you're very familiar with those as you watch the update. So let's bring in our year-to-date numbers for 2026. Strong showing continuing across the board, and bonds getting back in the positive territory. Again, that's price, and all these numbers are year-to-date. But again, I always feel like I got to say something about this. These are not what we are usually accustomed to with long-term equity appreciation. And so another very strong standout year, and we're, not even quite 9 months into the year. So let's go straight to Robert Marr, our Chief Investment Officer. Robert, we got a lot to talk about today, but what do you, you hear me try to make that comment every time we do the market update. And help me convey to the consumer and the investors out there that while this is all great returns and we'll take them, that they are just not typical.
They're not. So let me look at those numbers from a different perspective. 5 of them are in the last 5 years, 5 of those numbers you saw, the 2026 year-to-date total return numbers, are 1% to 2% lower than their all-time high. Non-U.S. developed markets, the foreign stocks, 0.07%, 0.07% off its all-time high in the last 5 years. So basically all-time highs were there. NASDAQ off, that's the worst. Okay, keep that.
Worst of the best.
The worst of the best. Down 3.35% from its all-time high of the last 5 years. So, 3.35%. Come on. That could be made up within a week on a good rally. So, the NASDAQ, like David said, very good numbers. If you're feeling like volatility or the tech story or, oh my gosh, the stock market is down, it was up yesterday, but it was down a lot before. Putting that into context, the worst of those 6 numbers, 3.35% off its all-time high, not bad at all.
So results not typical, but we'll take it. All right, so let's talk about an area, Robert, that you and I haven't had a chance to really get into lately. We talk about small caps and how well they've done year to date, up 22% year to date. Foreign stocks up almost 18%. And so there's a part of the market there that I think merits a little more conversation. That is a little bit of a forgotten story, and that is emerging markets. So how are emerging markets doing year to date, and anything in particular notable about them from an investor asset allocation standpoint?
Yeah, so we see, the foreign stocks up 7.7% year to date 2026. Last year, they returned 33% total return. Now, a component of that is emerging markets, but emerging markets by itself, let's throw up a chart. So the very middle number, purple, you see 20.64%. That's the S&P 500. That's what the S&P has returned for the past 1 year, just almost 21%. But look at emerging markets, 34% plus. Now, there's one other line there, and I have said this several times on this episode. China is a large component of emerging markets, and usually, hopefully I always put the word usually in, when emerging markets have done well, it's because China has carried it. Well, look at that light blue line, China, negative 7.46%. Now, that is the iShares China large cap ETF, so there are Chinese small caps, but a major component is those Chinese large caps down almost 7.5%, yet emerging markets are up 34%. So emerging markets are doing really well. China must be doing really well. Not the story this time.
So 3 things, couple things in there. Number one, so despite China lagging, the emerging markets are doing very well, which begs the question, if China does better going forward, that could really add to those gains that are occurring. And the other thing I think for a lot of people, when we say emerging markets and you think about emerging markets must be, as the name sounds, a market that's still developing and growing and all that. But then people are like, well, wait a minute. Isn't China like the second largest economy in the world and expected to pass the United States at some point? And so why are they still emerging? What's the deal there?
Yeah, there's always talk about rearranging emerging markets or redefining what an emerging market is. And there have been some small steps in that direction, but nothing substantive. But let me go into, if you think China, so why have emerging markets been doing so well minus China, or maybe including China? It's still so much has outperformed the S&P 500 in the last 1 year. Number one, South Korea. You don't think South Korea is an emerging market. They're a technologically advanced nation, yet they're still considered emerging markets. Same thing with Taiwan. Those are the two. South Korea up about 149% in the last year. Taiwan up about 88%. But half of South Korea's equity index comprises of two stocks, Samsung Electronics and SK Hynix. For Taiwan Semiconductors, depending on the metric you use, 44% to 58%, depending on the metric you're looking at. So basically, a large part of emerging markets, or the outperformance of emerging markets, is really a semiconductor story. So that's something to keep in mind when you're diversifying your portfolio. Like, yes, you think emerging markets is a great diversifier, and it is. But looking under the hood, if you have 50% in a semiconductor ETF, well, guess what? You're not really having as much diversification benefit with the emerging markets than you may think.
Good. So how about this? Let's go back to China more specifically again. They've had their share of challenges, as you know, Robert. And so
property slump still continuing with that. That's like 3, 4, 5 years in the making now. So they're still there. And number two, domestic demand, just still anemic, still lagging.
But their population is not growing quickly.
Not as quickly as it once was, but yes, not at all.
I look at the world chart, and I sometimes look at the population growth just to kind of keep a perspective. And India is still, largest population and is still growing.
Yes.
We haven't heard anything about this. Last thing I wanted to ask Robert, tariffs, our relationship with China. Are we all smoothed out there in terms of tariffs, as best you can tell? Is that affecting China and what's happening with their results as part of the emerging markets?
That's a complicated story. So there's always the issue with tariffs, a constant back and forth with that, especially with Iran and their oil imports. But as far as them hurting, they are kind of a secondary pushback. So our tariffs have forced them to diversify their supply chains and who they sell to. And Europe has been a large kind of absorption or sponge from what the U.S. has pushed back on. But now European leaders, especially Western leaders, are getting pushed back and now pushing back on. So China's kind of running out of different markets to sell to because they have enormous production and manufacturing capacity, and they need to offload it somewhere. So the United States pushed back. They went to Europe. Europe's now pushing back. So that may definitely be contributing to that. But I do know, looking at their export numbers, they're still growing double digits, not as fast as expected. They have missed some marks, but it's more the domestic demand and the internal population not consuming as much as they would like. That's kind of the main culprit, along with the housing. But that definitely may be playing into the calculus of the Chinese central bank. Absolutely.
The Chinese economy then is more export driven, more manufacturing driven, less consumer spending driven. Contrast that with the U.S. We're kind of, we're very consumer spending dependent.
And they are trying to get away from that. They are trying to, but it's been a longer road and a harder road than they expected. Yeah.
Okay, good. All right, well, lots to talk about, but that's good. That's good for now. We'll continue to monitor some of these developing stories and things that we don't talk about all the time, come back, talk about them, and focus on them like we did with China and the emerging markets. And we'll do that to help you continue to plan stronger.